Hi, good afternoon, everyone. It's Terry Gardner from C.J. Lawrence on Thursday, June 4th. There's clearly a lot going on in U.S. equity markets and the U.S. economy and in society in general. We're going to keep our commentary focused on markets and on investing because at C.J. Lawrence, that's our area of expertise. So with that, I'd like to introduce the theme of today's video, which is that the trend is your friend. But before delving into that, I wanted to review quickly three themes that we've introduced over the past couple of weeks. Take stock on where we are in terms of equity prices and the market's ability to digest information and to look forward. So those three themes would include leadership from the financials, two being a pattern of looking around corners, and three are introduction of the concept of the tilted V recovery. So first off, with regard to financial stocks, we had made the case a couple of weeks ago that it was important to see some leadership from financials for the broader market to have, the broader market recovery to have some sustainability. And in fact, we're starting to see it. The S&P 500 Financial Sector Index, which is still the second worst performing sector index year to date, is now the second best performing sector index over the last 30 days. And in fact, is outperforming the S&P 500 over the past week. And contributing to that, importantly, is outperformance from regional banks, which is nice to see and is a good underpinning for that index, and is constructive for the sector and for the broader market. Contributing to that is an improvement in the 10-year U.S. Treasury bond yield, which has risen about 13 basis points over the past 30 days. So good progress from financial sector over the past month or so. Second, with regard to looking around corners, we made this observation that the market was digesting information, then sprinting forward, pausing, gathering more information, and then engaging in another sprint forward. And we think that pattern has continued and will likely continue as the market searches for new information on the recovery in the U.S. economy, in corporate earnings, and even in coronavirus cases. So the pattern of looking around corners it continues. And then thirdly, we had introduced the concept of the tilted V recovery. If you remember this great visual that we introduced. And I apologize, my trusty assistant is not with me today. She's out playing in the yard with her sister. Maybe she'll rejoin us shortly. But the point of this was that most recoveries are described in terms of a V shape or a W shape or a hockey stick shape. And our view was that this is a fairly unique recovery and pattern, and that would likely take the pattern or shape of a tilted V, whereby the decline was precipitous, which it was, and the recovery would be more gradual. So the tilted V is still very much intact, and we would expect that the economy and the stock market will continue to follow that pattern. So then finally, fourth, our point of today's video, that the trend is your friend. The trend is very much intact and is positive, and our point is to not fight it. The market breadth is improving. We're seeing leadership from financials, which we were looking for, and the economy is bottoming, and the process of reopening and recovery has begun. And that is historically the type of backdrop that is quite constructive for higher stock prices. That's, of course, we're not ignoring any of the risks that are on the horizon. There's always the black swan event, the event that you don't see. But of those that we can see, there's clearly some risk with regard to U.S. and China trade relations. A second trade war would be disruptive to U.S. economy, particularly in its fragile state, and that would probably have a ripple through the U.S. stock market. Secondly, any potential resurgence in coronavirus cases would be negatively received by the stock market. And then thirdly, one of the things we want to keep an eye on is whether or not we'll see a major political shift towards a platform that is less business friendly and less market friendly in advance of the November election. So it's clearly a couple of things we want to keep an eye on. So what do we do from here? Well, the point is, if it ain't broke, don't fix it. We've all heard that phrase, and that applies here. So our view is, stay the course, stay invested, and stay focused on owning and investing in companies that are disruptors, that are disrupting their industries and their sectors, and in companies that are growing market share and gaining share, particularly catalyzed by this downturn in the economy. Companies that come out on the other end stronger are companies that we want to own. And then so finally, I want to leave you with this message, that this is actually what we do at C.J. Lawrence. We don't just talk about markets and stocks, we actually invest. And that's why our institutional partners choose to partner with us, and that's why individuals and families and foundations choose to hire us. We eat our own cooking, as the saying goes. We do our own work, we form our own views, we develop our own thesis, and we invest our own and our clients' capital against it. So if you'd like to learn more about C.J. Lawrence, or would like to talk to us about potentially becoming a C.J. Lawrence client, I encourage you to visit our website. Our main number's on there at cjlawrence.com, or reach out to me directly at tgardner@cjlawrence.com, or give me a ring at 212-888-6403. Look forward to hearing from you. Until next video, be well and be safe.